Have you ever pondered on the distinguishing factors between Islamic and conventional finance? Well, let's untangle this financial conundrum together. Finance, as we know it, is the lifeblood of our economy. It's the system that allows for the flow of money and the allocation of assets. Now, there are two major categories that we're going to focus on: conventional finance and Islamic finance. Conventional finance, the system most of us are familiar with, operates worldwide and is based on free market principles. On the other hand, we have Islamic finance, a system rooted in the principles of Sharia law which governs all aspects of a Muslim's life. It's not just a financial system, but a way of life. Now that we've set the stage, let's delve into the basics of these two financial systems. Starting off with conventional finance, what principles guide this system? At the heart of conventional finance sits the principle of the time value of money. Simply put, this means $1 today is worth more than $1 tomorrow. It's based on the idea that money can earn interest or create income over time. Another cornerstone of conventional finance is the concept of risk and reward. Essentially, the higher the risk an investor takes, the higher the potential reward. Conversely, if you opt for a lower risk, you can expect a lower return. And then we have the concept of interest, often seen as the backbone of conventional finance. Lenders charge borrowers interest for the use of their money. This interest is the cost of borrowing, and it's how lenders make their profit. With these principles, conventional finance has dominated the global financial landscape. But what about Islamic finance? Islamic finance, on the other hand, operates on a distinct set of principles. What are these? First, Islamic finance prohibits interest, or riba. This means that money cannot be made from money alone. Instead, it emphasizes risk sharing and real economic activity. For example, in a business transaction, both parties share the risk and the reward. Second, money is viewed not as a commodity, but as a medium of exchange. It's a tool that facilitates trade, not an asset that grows on its own. This principle is closely related to the prohibition of riba, as it forbids making money from money. Third, all transactions in Islamic finance must be backed by tangible assets. This means that speculative transactions, like derivatives and short selling, are generally not permissible. It's a system that promotes stability and discourages excessive risk-taking. These principles make Islamic finance unique. But what are the practical differences between these two systems? Now that we understand the principles, let's examine the practical differences between Islamic and conventional finance. One of the most noticeable differences lies in how each system structures loans. In conventional finance, a bank lends you money and charges you interest over time. This interest, or usury, is a key profit driver for the bank. However, in Islamic finance, usury is prohibited. Instead, a bank might purchase an item for you and sell it back to you at a higher price, with the difference being their profit. The bank takes ownership and risk of the item until you've paid it off. When it comes to investments, Islamic finance also stands apart. Instead of investing in anything that might turn a profit, Islamic finance principles dictate that investments must be morally sound and contribute to society. This means avoiding industries like alcohol, gambling, and pork, which are considered haram or forbidden. Lastly, while conventional finance allows for speculation and short selling, these practices are prohibited in Islamic finance. Speculation, or betting on the future value of an asset, introduces unnecessary risk, which is discouraged in Islamic finance. Short selling, which involves selling borrowed shares in the hope of buying them back cheaper later, is considered dishonest, as it involves selling something you do not own. These differences in operation reflect the underlying principles of each system. But what's the impact of these differences? The differences between Islamic and conventional finance have significant impacts on the economy and society. Islamic finance, with its emphasis on risk sharing and prohibition of interest, can foster more stable financial systems. It also advocates for ethical investing, aligning monetary practices with moral principles. In conclusion, while both systems aim to facilitate economic activity, they do so in fundamentally different ways. Whether one is better than the other is a matter of perspective and personal beliefs.